All right, let's jump straight into this explainer. Today, we're tearing down the anatomy of the Amplius Aggressive Asset Allocation ETF, better known by its ticker, AAA. We're going to strip this actively managed fund right down to the studs. We'll look at the data, the core strategy, and of course, the SEC fine print to really understand the true story behind this unique financial invention and what makes it tick. So picture this. You're a retail investor, or maybe a wealth manager, and you're sitting on a highly concentrated stock position that has absolutely skyrocketed. It's a great problem to have, right? But here's the catch. Diversifying to protect that new wealth usually means getting slammed by massive capital gains taxes. That exact headache is why the AARA ETF was invented in the first place. It was literally designed as a tax-smart vehicle to help investors shed that heavy concentration without triggering a massive tax bomb, smoothly transitioning them into a diversified portfolio. And that leads us to the core behavioral philosophy over at Amplius Asset Management. They have this saying, the best investment strategy is the one investors can stick with. It sounds incredibly simple, but honestly, in the wealth management world, it is profound. Their whole framework is built on a harsh reality. Yes, asset allocation drives long-term returns, but human behavior, our tendency to absolutely panic and sell everything when the market drops, that's what actually destroys wealth. They're inventing a portfolio built for human psychology, not just math. To solve that behavioral puzzle, they engineered a very specific objective. This is an aggressive, actively managed fund hunting for capital appreciation. But here's the kicker. They aim for less volatility than an all-equity strategy. Essentially, they want to hand you the aggressive growth of a stock-heavy portfolio, but with a built-in shock absorber. That way, when the market inevitably gets rocky, you don't panic sell. So how do they actually build that out? Amplius uses a very disciplined top-down blueprint. Think of it like building a house. Step 1 is the big picture, the foundation, deciding the macro split between equities and fixed income. Step 2 is framing the rooms, drilling down into sub-allocations like US versus international or growth versus value. And finally, step 3 is the finishing work, the surgical security selection where they pick the exact assets to fill those buckets. Now, that top-down process leads to a serious commitment to stocks. Aggressive's in the name for a reason. They target a global equity allocation anywhere from 60% up to 100%. So you're probably wondering, where's that shock absorber we talked about? Well, whatever isn't in equities is systematically parked in fixed income or specialized downside protection ETFs. They stay strictly within these predefined ranges to keep the strategy on track over the long haul. Let's look at the actual numbers here because they're fascinating. AAA is a relatively new player. It just launched in July of 2025. But get this, by mid-2026, it had already pulled in over $277 million in net assets. That is serious traction for a new financial invention. And you got to pay attention to the costs. The gross expense ratio is 0.57%, but they have a fee waiver right now that drops the net expense ratio to a highly competitive 0.49%. For a fund doing complex, active tax management and duration overlays, coming in under 0.5% is a massive detail if you're watching your costs. Peeling back the layers on what's actually inside this thing, they aren't just out there picking individual stocks. They're using massive, heavy-hitting ETFs as building blocks. We're talking huge weightings in the NASDAQ 100 through QQQ and the S&P 100 through OEF. Combined, that's over 21% of the fund dedicated to the biggest, most dominant U.S. companies. But then they balance that out. They've got international exposure through emerging markets, and then you see that defensive sleeve kicking in with things like SHY, which tracks short-term treasury bonds. But keep in mind, this is an actively managed fund, meaning things change. For instance, recent data shows the fund dumped about $15.7 million worth of its QQQ shares. Now, before you think they're suddenly abandoning the tech sector, notice that QQQ is still absolutely their top holding. This is just active management in real time. They're taking some chips off the table, rebalancing the portfolio, but staying fundamentally bullish on those underlying tech companies. And what has all that active maneuvering actually achieved? Well, since it launched about a year ago, the fund posted a 23.43% net asset value return as of June 30, 2026. That is a phenomenal first year right out of the gates. But as the SEC filings explicitly state, and as I definitely need to remind you, past performance absolutely does not guarantee future results, especially when you remember this fund doesn't even have a full calendar year of history yet. Now, while capital appreciation is clearly the star of the show here, let's talk income. Because the fund holds dividend-paying stocks and treasury bonds, it does actually kick off some cash. It's a 1.29% yield paid out quarterly. Is it going to buy you a yacht? No, probably not. But it is a really nice little cherry on top of that aggressive growth profile. When we look at the pricing mechanics, the fund is running like a well-oiled machine. The net asset value is sitting at $30.18, and the market price is practically identical at $30.17. That means AAAA is trading at a microscopic discount of just 3 basis points. You are essentially buying this entire basket of assets for fractions of a penny less than what they're actually worth. So, if we zoom out to summarize this whole financial invention, it's really about a constant tension between growth aspirations and defensive tactics. The growth engine is fueled by that massive global equity target. But to keep investors from jumping ship when things get scary, Amplius engineered those active defensive overlays. It's a calculated, systematic attempt to smooth out the ride, trimming those extreme highs to avoid the most brutal, panic-inducing lows. But listen, our job in this explainer isn't just to repeat the shiny marketing brochures. We have to impartially look at the caveats. When a fund files with the SEC, they're legally required to lay out every single way the strategy could blow up. So we absolutely have to weigh the risks just as heavily as the rewards. Let's rapidly unpack those legal warnings, plain and simple. First up, new fund risk. Like we said, it launched in 2025. There's just not enough operating history to know how this strategy handles a massive recession. Second is allocation risk. This is active management, meaning the managers could just be wrong about where the market is heading and the fund could underperform. Third, non-diversification risk. Because they make highly concentrated bets on specific ETFs, a drop in one area hurts them way more than a broad index fund. And lastly, standard market risks. If global markets tank, the assets inside this fund are going down right with them. But out of all the fine print, this is arguably the most critical reality check. We talked a lot about that defensive sleeve acting as a shock absorber. Well, the SEC requires them to be completely blunt. Downside protection ETFs do not offer guaranteed principal protection. Using these defensive tactics doesn't make this a risk-free magic bullet. You can still experience massive losses, up to your entire principal investment. A smooth ride is absolutely not a guaranteed ride. Which brings us to the final and most important variable in all this, you. We've seen how AAA was invented to solve the very real tax headaches of concentrated stock, attempting to balance aggressive tech growth with defensive safety nets, and we've looked at the very real risks of active management. So the question is, does an aggressively managed, tax-optimized strategy actually fit your own personal risk tolerance and timeline? I'll leave you to ponder that one. Thanks for joining this explainer.